Tech sells off again, 30 minutes until the start of your cash equity trade. I'm Dani Burger. Matt Miller still out. Bloomberg Open Interest starts right now. On today's show, chip stocks tumble again as fears mount over China competition and circular AI funding. Earnings season gathers steam, offering a fresh read on the economy and the consumer. And the U.S. and Iran continue to hold fire as Netanyahu and Zelensky meet with President Trump in Washington. So the stocks we're looking at today, after that painful sell-off in the Kospi, are chip stocks. They are down again this morning. We still have earnings from Apple, Amazon, Microsoft, and Meta tomorrow and Thursday. So again, the Kospi, it fell 10%. That's its second biggest drop since 2001. It's hundreds of billions of dollars in deals that started to reignite those circular fears, and China making progress with its AI ecosystem. Also want to point out we have a number of earnings this morning. UPS, they reported raising its sales forecast on a turnaround progress. Not good enough. Shares fall 3%. Boeing higher by just under 1%. Surprise positive cash flow, but they did have a $280 million charge related to its Air Force One program. Finally, Coca-Cola slightly raised its earnings guidance after a World Cup sales boost. But the main story this morning, we begin with the AI and chip slump. Joining us now is Bloomberg macro strategist Michael Ball. It really did start and was fueled by the Kospi overnight, that biggest drop since the early 2000s. What do you make of the selling that we've seen, whether there is something fundamental to the story about the China pressure or it continues to be an unwind of momentum?
No, it's mechanical to the max because of all the leverage, especially in Korea. There's a lot of retail guys are getting margin called day after day now as you see the weakness come out at the Kospi. Also, you just had the narrative change, but I don't think that was necessarily a short-term narrative change. It's a longer-term story. It's going to take China a while for the memory stocks, especially for the lithogram machines. It's all coming, and we knew it would always be coming. But because of this position was so leveraged and so long one direction, there was only a little bit of catalyst that could knock it down, and that's exactly what we've seen now for 2 sessions in a row.
Does that mean then that the setup going into this earnings with some of these hyperscalers, with Amazon and the others this week, is more constructive because they have been selling into this report?
Yeah, so valuations look interesting now for some pockets and some single names for sure. I think, unfortunately, when I look at the option positioning, it's still very fluid, meaning we're still skewed very negative. It means that dealers and sort of flows are going to chase moves. So if we get weakness, it gets exacerbated by hedging flows. If we get strength, it can also do the opposite, and you can see rallies. So what you should expect is higher vol, and we've already seen sort of negative results in the price action following earnings results. So I would actually think you're still going to skew a little bit negative coming out of some of the hyperscaler earnings.
So it's a busy day tomorrow. Not only do we have some of those earnings, we have a Fed decision, too, that's going to keep us all busy. Citadel Securities saying that they see Warsh delivering a surprise hike. The market pricing in about a 1 1/3 odds that we do see a hike. Does 1 in 3 sound right to you, or is there a bigger chance you believe that we will get a hike from this
So I'm
Fed?
leaning that we do get a hike. I think Warsh really wants to establish credibility. I think he has the votes on the committee. I think this is about proving that he doesn't believe in forward guidance, not just saying it. We obviously had a hawkish June statement from him, and we saw in the testimonies in Congress that he was leaning more towards focusing on inflation. The macro backdrop gives him some cover. We have a decent final domestic demand. We're at 3.2%, although GDP itself looks weaker because of the imports. And the inflation, as we know, is just moving sideways. Now, the worry would be that we're going to get weaker inflation coming, and he's going to lean into that the wrong way. But honestly, if he really wants to get the credibility he needs to implement some of these larger changes he has in mind, he has to go now, and I think he has the backing of enough of the committee.
If we don't have forward guidance, though, and he does go now, how will this bond market even react? Because is it a Fed getting ahead of the curve, or is it a Fed worried about inflation? We won't necessarily know, I'm guessing, if we don't hear forward guidance or more thinking from the Fed.
I think the front end will see greater volatility because there's going to be a debate whether he wants to erase these Powell risk management cuts, which, as we know, were about 75 basis points, or if this is a one and done, go now, maybe you don't have to go later, and it just establishes that credibility that the market needs. Honestly, it's a little bit of a flattener, but again, initially, anyone's guess to what might happen tomorrow on the reaction, because his communication will still be pretty limited from what we saw in June, and we won't know how much further they intend to go if they start. And usually when they start, they go a couple times.
Michael, thank you so much for joining. Looking forward to catching up with you throughout the week. That's Bloomberg's Michael Ball. Let's turn now to earnings of Boeing specifically, shares fluctuating after the plane maker topped expectations on cash flow. For more, we're joined by Bloomberg Boston Bureau Chief Brooke Sutherland, who covers the industrial sector. Brooke, what did we learn?
I mean, I think the positive free cash flow number here, beating expectations, is really the main takeaway. Yes, you do have another charge on Air Force One, but I think there is some comfort that this is, sort of a long-standing albatross for Boeing and not a new problem. And I think you're seeing a lot of investors trying to pivot into that plane making space as you start to see some deceleration in the aftermarket. That's, the maintenance services, the spare parts. That has been the part of the aerospace market that's really been booming the last couple of years. You've seen a ton of pricing power, a ton of demand, just because we did have those supply shortages of new planes. And I think you're going to start to see a bit more of a rotation toward the plane makers, just as we start to see, some of that momentum decelerate in the aftermarket. We've already seen a number of those companies like GE Aerospace, for example, selling off on what were nominally very good results, but just a lot of concerns about a little bit of a slowdown in the aftermarket.
We also heard from JetBlue this morning, Brooke, citing more demand. How is the turnaround effort going at that airline carrier?
I think they're making progress, and it really echoes what we've heard from a number of the airlines, is that despite the high fuel prices, they're still seeing very strong demand. Now, I think the question is, how does that hold up when we get into the fall? If you wanted to take a summer vacation, you were probably not going to be dissuaded by $50 extra on your air ticket fare. But that might change if it's sort of an extra side trip in the fall. That might be where we start to see consumers express a little bit more caution. And so I think there's a lot of questions about how that demand holds up as we proceed into the fall. The airlines are saying they can hold on to these price increases, that even if we start to see fuel costs, come back down and stay back down, that they will retain this pricing power. But I think, a lot of skepticism about their ability to do that, because they have not historically been able to hold on to that.
All right, Brooke, thank you so much for joining. That is Bloomberg's Brooke Sutherland. Elsewhere, UPS boosted its sales guidance for the year as it pivots from low-margin e-commerce shipments to more profitable packages. Bloomberg's Matthew Griffin joins us now. Matthew, I was looking at the Jefferies analyst reaction, saying there's not much to pick at with respect to quarterly results, and yet shares are down 4.4%. Is this just high expectations for UPS?
Well, Dani, thanks for having me on. I think it's a sign that UPS really remains a show-me story with investors. So, of course, we have this outlook for the year being higher. We actually have some upside in results in the second quarter. But before the earnings call began, you had some analysts talk about this outlook implies results really going to have to ramp up in the back half of the year. And just now on the call, company talking about maybe some of the pricing increases that they're seeing moderating, as these fuel surcharges come down, for example. And so investors, again, they're getting a positive outlook, but investors really want results from this company after waiting for 18 months for them to turn things around.
Well, part of it does seem to be tied to this Amazon business that they've shed. How has that effort gone?
So far, the early signs seem positive. So we saw margins increase year over year in the quarter. Again, the company raising its full year revenue outlook. Those are the kind of things you want to see if this company is succeeding in ditching these low cost e-commerce shipments in favor of, for example, complicated, expensive healthcare packages. And Truist says companies executing well, they expect earnings to inflect. Again, though, some of that upside is baked into the back half of the year. So investors, they're going to have to wait a bit to get the final confirmation here. And the stock still trades below where it did before they announced that glide down, as they call it.
So some of the pressures from fuel, they say, are going to start to alleviate themselves. What about other costs, like labor costs for them?
Labor costs, that was another potential negative in the report. So labor costs, they were more than $12 billion. Citi calls that out as being higher than their estimate. Of course, UPS, they had that big contract with the Teamsters a couple of years ago. So labor costs, something that they've been dealing with and having to kind of explain to investors since then. They have been growing revenue. They've been offsetting that elsewhere, but it's still a pain point for Wall Street right now.
All right, Matthew, thank you so much for joining on those UPS earnings. Bloomberg's Matthew Griffin. And later today, UPS CEO Carol Tomé will be joining the close. That's at 3:30 p.m. Let's get a check on markets. Just 20 minutes to play for until your start of your trading day. We are down. It's the NASDAQ down 0.6%. Not nearly as bad as we saw in the Kospi session, but it still is tech dragging us lower today. The 10-year yield material. That comes in by 2 basis points ahead of a Fed decision tomorrow as Brent crude drops now below $87 a barrel, falling 2%. Let's look at some of the single name movers this morning. With that is Nora Melinda. Hey, Nora.
Hey, Dani. 3 stocks I'm watching for you this morning. Let's kick things off with Royal Caribbean. We're seeing shares down by about 0.1% in the pre-market trade. Now, this comes after the company trimmed its full year estimate for the amount of money that it makes from passengers. Now, that's all despite raising its earnings outlook and saying that trends for its 2027 bookings topped estimates. Now, from here, some job cuts at Visa. So we are seeing the stock pushing higher, up about 1.5%. This is after news that it's cutting 7% of its workforce. That's about 2,600 jobs. This in hopes to be more efficient as it competes in a tough industry. The cuts will affect mostly tech and product teams as it invests in new areas like stablecoins and cross-border payments. Finally, let's wrap things up with Johnson & Johnson. We're seeing shares higher by about 1.8% in the pre-market trade. That's after the company agreed to a $5.5 billion commitment to resolve litigation related to its claims that its talc products cause ovarian cancer. The company still denies that the powder was harmful, but the settlement will help close an issue that's dogged the company for at least 15 years. Those are your morning movers. Dani?
Nora, thank you very much. We'll catch up with you later in the hour. Coming up, Apple and Klarna team up to launch a new leasing program. We're going to bring you the details coming up next. This is Bloomberg. Let's get you some high interest stories. A look at what's making headlines around the world. President Trump said the U.S. will, quote, take out Pickaxe Mountain if it doesn't reach a deal with Iran. His comments come as Omani negotiators continue talks in Tehran aimed at restoring shipping through the Strait of Hormuz. Oil is continuing to drop as the U.S. and Iran extend their pause in fighting. Israeli Prime Minister Benjamin Netanyahu is scheduled to meet with President Trump at the White House at 11 a.m. Eastern. Trump told Fox this morning that Netanyahu wants the U.S. to stay involved in the Iran war. But first, President Trump will meet with Ukrainian President Volodymyr Zelensky at 9:30 a.m. Zelensky is expected to seek additional help to strengthen air defenses against Russian attacks. And in tech news, Apple has launched a new product leasing program provided by Klarna called Apple Upgrade. The program offers pricing options for the iPhone, Apple Watch, Mac, and iPad in online and retail locations in the U.S. iPhone leases start at $17.99 a month. Let's discuss this and more with Bloomberg Tech host Ed Ludlow. And Ed, I know Mark Gurman had reported on this about 10 days ago that we were expecting something of this leasing program. What are the details and what does it help Apple achieve?
Yeah, so in the first instance, it's US only, but it gives the consumer flexibility to, frankly, upgrade, buy, return any Apple device at any time. The new bit's the pricing, right? So for an iPhone through Apple Upgrade, you can pay $17.99 a month, Apple Watch $11.99, Mac $24.99, iPad $11.99. Probably on the handset side, on the iPhone side, you know, the story here is that it's an alternative financing to what the carriers offer. Right, and you know, Klarna, along with a sort of growing field of financing or buy now, pay later options, is muscling in on the home turf of those carriers a little bit, because when we talk about generation to generation handset releases, you know, a lot's made of the price and whether Apple or not raises prices in the environment relative to higher memory or component costs, etc. But the reality is that the carriers often grease the wheels on that market because of trade-ins and the fact that you finance it anyway. So it's an interesting development. I would say I don't know that Apple's shares moving in the pre-market, I wouldn't draw a direct causal link on that, given it, you know, it's already out there, but an interesting move nonetheless.
I mean, part of the reason Apple's move has been interesting is because it's overtaken the market cap in NVIDIA for the first time. It looks like since May of 2025 that it yet again is larger than NVIDIA. Just given that NVIDIA and the other hyperscalers have been hit as spending increases and Apple hasn't been increasing its spending. Ed, what do we know about continued progress with Apple's AI plans and maybe how they stand out in this market, because they have not been committing to spending to make that happen?
Yeah, so I mean, we're showing the year-to-date chart, right, which is Apple's gain of 24%. And part of it taking the title of world's most valuable company is that NVIDIA's downtrodden and has been under pressure of late with the chip stocks entering a bear market, etc. But the stock is interesting. It is the outlier relative to the hyperscalers, because it doesn't have the capital expenditure story. You'll remember there was a time where Apple was under a lot of pressure to demonstrate that it was willing to spend on talent or R&D to get going in the field of AI, but it's completely insulated from now what is CapEx concern. And the stock's been given credit for that. You know, it's been not just insulated, but sort of cheered as saying, okay, we like that story. It's in an environment, again, where when earnings roll around this week, the story will be about the environment of higher component costs. But typically, Apple is the master of the bottom line. And it will be really interesting to see how they've managed that and the trajectory of the stock thereafter.
Just given that, Mark Gurman also reporting this morning about new home products, a new wave of home products tied to Siri AI. Ed, what do we know about that? And again, how this fits into this wider narrative of Apple?
Yep. Yeah, Mark Gurman's been busy.
Yes.
Biggest home push yet. You know the market. It's taking on Google Nest and Amazon Echo devices. And there's a lot of detail in here. So basically, Apple is coming with a new smart home hub, a new Apple TV design, and a new HomePod mini. The Apple TV and HomePod come in the fall, according to Mark's reporting. The smart home hub comes between October, maybe early next year. And the main point is that now that they've made some progress with Siri AI, they want a device at the center of the home where you can leverage it in the same way that you communicate with Alexa via Amazon Echo devices. We're an Amazon Echo household. On the AI side, the software side, it's just not there. On the hardware side, it's easy. So it'll be interesting to see. Mark has some limited details on how they'd price those relatively aggressively for Apple entering that market. But, again, like the stock being up 0.7%, is it a huge needle mover for Apple? No, but it's a very serious push if Mark's reporting is accurate.
And hopefully we'll hear more details when Apple reports its earnings this Thursday on the 30th. Ed, thank you so much. Bloomberg Tech host Ed Leather. Look out for Bloomberg Tech, 11 a.m. every weekday. Coming up, more corporate stories. Visa cuts 7% of its workforce as it doubles down on AI and digital payments. That's next. This is Bloomberg. Visa is cutting about 2,600 jobs, roughly 7% of its workforce. The payments giant is looking to streamline operations and reinvest in areas including AI, stablecoins, and cross-border payments. For more, Bloomberg consumer finance reporter Paige Smith joins us now. Those are broad level, some of the justifications they gave. What exactly is Visa doing here?
I think substantively it comes down to this moment in time where the payments industry is really dynamic and evolving very quickly. And there are a number of firms basically trying to make tough decisions about how to allocate their capital and where to really substantively make those investments. And, according to the memo that we obtained, Visa called out some really high growth opportunities for them to really allocate their people to sort of reinvest some of those savings, I suppose. Those are areas like stablecoin technology, agentic commerce, and, also just growing and evolving consumer payments that we rely on every day.
What are the low growing areas then that they're backing away from?
I think it would be fair to say that it's a competitive dynamic, right? Okay. So these are sort of internal deliberations about where it would be most valuable to invest.
So they, like a lot of companies in recent days, including PayPal and Block, you talk about in your report, have kind of said, oh, we're using a lot of AI, and so we're becoming more efficient. I mean, it must be difficult for you, but how as a reporter do you kind of distinguish what is sort of the AI theater and what is true productivity gains that means they need fewer workers?
I mean, I'll speak for myself personally. When I look at these firms, it's sort of, I look at, first of all, just how mature they are as entities, and also the ways that they have historically talked about AI. So you talk about a company like Visa, where they have spoken about how they've used artificial intelligence and fraud and security capabilities for years and years. And to be totally frank, I don't think that all companies have been using that kind of language, and as they've spoken with reporters and with the public generally.
And again, PayPal, you've also been reporting on, they beat their earnings estimate. But maybe just to underscore how competitive it is, there's still those deal rumors swirling around PayPal. Yes. PayPal, just how difficult is this landscape right now that sure you can have a good quarter, but maybe you still get bought out?
I think it's incredibly difficult. And you also, to pull in even another company like Block, for example, that earlier this year they announced a major job cut as well. So it's sort of like these are all firms that are competing for the same consumers, the same customers on a business standpoint, from a business standpoint, and it's tough out there. And we're watching all of these companies very closely to see how the landscape develops, who wins, who loses, what deals happen, and frankly, what deals don't happen.
I mean, I was even just thinking about that Apple news we had earlier, that Klarna's helping them doing financing. I mean, that's also, a buy now, pay later, but it's a UK firm. There's also been Brazilian firms who are fintech that have listed in the US. How much of it isn't just US competition, but is very much so international?
So we've reported pretty extensively on this, actually, of these entities that are moving into the US and, again, also trying to vie for the same customers. Right. So it's like they're certainly, to keep it all in perspective, right? Like the American consumer pie, if you will, is huge. There are a lot of pieces to go around, and there are a lot of different services to go around. I, for example, I have a primary banking relationship, but I might also have a buy now, pay later relationship with a few providers. I have a couple of credit cards. Like there are a lot of different opportunities to gain the same consumer, but it's still really competitive, and your terms and your opportunities and your incentives need to be very, very competitive to vie for those consumers.
Paige, so interesting. Again, excellent reporting throughout all of this. Thank you so much for joining us. That's Bloomberg's Paige Smith. Let's get a check on your equity markets. Just minutes to go until your opening bell, and it continues to be that follow through from a very negative Kospi session, one of their worst since the early 2000s. Even so, it is an S&P that continues to gain. We did ever so slightly gain yesterday, except for tech. And then meanwhile, yields are coming in, so that's helping the overall market. Yields, in turn, are being helped by Brent crude down 2%. Even still a 1 in 3 odds that this is a Fed that hikes tomorrow. Coming up on the show, Katrina Dudley discusses whether this week's drop is a healthy reset or a sign that investors are truly questioning the AI trade. That's to come. This is Bloomberg Open Interest. Moments away from the start of trading, you are watching Bloomberg Open Interest. I'm Dani Burger. Just seconds until we start your trading day, and we are flat on the S&P 500, NASDAQ 100 futures. Those are down 0.8%, again, after an ugly session, a decline of more than 10% from the Kospi. It's the same things that we had in yesterday's session, concern about spending, circular finance, and at the same time, the advancements being made from China. Eagle Rock opening the bell down at the New York Stock Exchange. They do land and resource management, which I guess is important in this day and age where everyone's building a data center on the land that we have. Pretty cool. Down at the NASDAQ, we have Wrexham, the CEO over here. I can't remember his name. I know he came from AC Milan, I want to say, when he came to Wrexham, ringing the opening bell. The NASDAQ, down at the NASDAQ, I should say, Wrexham and Liverpool are going to be playing a friendly at Yankee Stadium tomorrow, a preseason game, and we will be speaking with the Liverpool FC CEO in the next hour, so that is one to pay attention to. What we're now paying attention to in this market is the chip and tech stocks. They continue to sell off this morning. They're down. We're going to have earnings from Amazon, Apple, Microsoft, and Meta. That will happen tomorrow and Thursday. As I mentioned, the Kospi fell 10% today. It's the second biggest drop since 2001. Hundreds of billions of dollars in deals have started to reignite fears of circular funding, all while China makes progress with its AI ecosystem. Some numbers on earnings to also look out for this morning. UPS raised its sales forecast on a turnaround progress. The market wants to see more, though. Boeing reported a surprise positive cash flow, but also a $280 million charge related to its Air Force One program. Coca-Cola, the lone gainer on that board there, slightly raised its earnings guidance on stronger sales volume, also helped by the World Cup. In general, though, we have seen high beta momentum stocks getting hit hard lately as fresh AI concerns spark a rush out of this year's biggest winners. But history does suggest that sharp momentum sell-offs can create attractive entry points for longer-term investors. Quite a few different charts we're looking at there. That's as long as the underlying fundamentals remain intact. We did have a chart for you showing that momentum has had one of the biggest crashes in recent times. So let's bring in Franklin Templeton, Senior Investment Strategist Katrina Dudley. Katrina, has something changed for you around the fundamentals? Is this something different with China threat and more spending, or is this just a momentum crash, and it's as simple as that?
Look, let's have a look at what happened in the last week. And if we look at a bullish indicator, and about 45% of investors were bullish, that number's come down to 29. Where it really is that buy indicator, so we look at post the tariffs, actually, if we go back, and that number kind of gets down to 20, so 20% of the market is bullish or investors are bullish, that's a really strong buy signal. So we're kind of a little bit in that no man's land, so it's hard to kind of say, hey, do this. But let's take a look at what's happening and what's driving markets. We've been talking for so long about this broadening trade, and we've really seen a broadening of the market. And number two, we have seen earnings growth. I appreciate all of these negative headlines that are coming up about AI, the circular trade, but you just talked about it. UPS, good numbers. CSX last week, Norfolk Southern last week. These are companies that are real industrial companies that are, drivers of our economy, and they're saying that things are actually doing well. They're beating estimates and raising. If I look at 2026, we've got 17% earnings growth. 2027 is 16. So the earnings growth is there to support the market. Valuations are reasonable. So I really just don't see that we're in for a crash.
We're looking at a chart here that I wanted to bring up because we have seen Apple's market cap surpass that of NVIDIA to become the world's largest stock again for the first time since around May of last year. And before it was the earnings that were really propelling us were AI, it was the chip makers. And Apple notably is a company that has not been spending. It's not a picks and shovel. It hasn't had huge numbers in capital expenditures. Has what's important for this market changed?
I think that what is important for the market is, number one, the consumer. We are still a consumer-driven economy. And I know we've been talking so much about AI, but realistically, it is the consumer that drives the U.S. market. And Apple is tethered to that consumer. You think about Amazon, the services that we consume there. We look at the iPhone sales and everything. So they are a play on the consumer. And I think that that's what's been reflecting is this strength of the consumer is something that is really standing out to us. We've got a resilient consumer. We've got a strong economy. You've got reasonable valuations and you've got earnings growth. I don't think there's much else you could ask for in this market. And so many people I know they're focusing on this AI circular trade. We think that if I have a look at one of the data points that we've been focusing on is the revenue that is coming out of these companies, and we're looking at that relative to depreciation spending, and that's actually in positive territory. It's a good sign.
Well, I know Mike Wilson of Morgan Stanley had a piece out yesterday saying that finally AI is going to start paying off for companies that are using it and margins are going to expand. Are you expecting that too? Because it's something we've been watching out for, and we haven't quite heard it in earnings. You do hear someone like a Visa saying they can let go of people because they're increasing AI efficiency. But is that starting to show up? Are you trying to pick out the AI winners at this point?
In terms of the ROI, there's two places we're talking about ROI. We're talking about ROI in terms of the CapEx spending, and you're right, we're also talking about ROI at enterprise customers. And I think that that's something which we've always expected to be longer, because it's not suddenly that, we're in a regulated business where I work, and so we can't just suddenly change all of our processes. We've got to go through there, we've got to test and do all of that. But we're seeing efficiencies from introducing AI. We introduced it to our sales force. They've got a 10% uplift in their efficiency. So we're starting to see these pockets of efficiency come through. The spending numbers are still there. So I'm not sure that you're seeing significant positive ROI, but you're not seeing a huge negative amount of spend without at least some offside on the cost side.
I was going to say, I happen to know that you use AI a lot and you experiment with it a lot too.
We do, and that's what we've been encouraging all of our investment teams to do. And I think people are at different points on their journey, and we want to be respectful of that. But we're really starting to bring all of our investment teams along. And what we're seeing is that it creates efficiencies. That means you can, the simple cases where you can digest an earnings call faster. But now we've actually seen some really innovative use cases within our investment groups, and that's where we're going to start to see these efficiency gains come through. And that's really positive because it drives, the opportunity for more alpha from so better performance. It also drives, more asset growth for our investment teams, and we're an asset manager, but also drives that efficiency.
Well, if the threat isn't going to be coming from earnings and those look robust, could it come from higher rates? This market pricing in a 1-in-3 odds the Fed hikes. Citadel Securities coming out saying that they expect Warsh to hike. Could that be something that also hampers this rally?
Yeah, that is actually the one concern. It's rates. It's really that 5% level that we've been focused on, because at that 5% level on the 10-year, we do expect some degree of rotation, because you've had such strong performance of the equity markets, and then that kind of attractive yield on the, in the fixed income. In terms of going into the FOMC meeting, I would put it as, I hate to say a coin toss, because that's really not helpful. You're looking at 1 in 3. I think that's about what the market's telling you.
Right.
We're trying to balance out, his comments about price stability and wanting to restore price stability. You've seen the move in oil prices up 40% in the last 2 weeks. So, those inflation concerns are starting to come back into the market, and that's what we think is the concern going into the meeting, that you could see a small rate hike as he kind of, stamps and says, I'm really focused on price stability.
All right, Katrina, so lovely to have you on. Thank you so much for joining us, always. Franklin Templeton's Katrina Dudley. About 8 minutes into your trading day, let's get a check on your equity market. And we are looking at broad losses, not broad losses, rather. Most of the stocks are up, but only 136 are down. But we are declining about 0.1%. That is different from the future session where we were gaining. On the upside, you do have some of the earnings we're going to be getting this week. Apple, one of the performers. Microsoft is up there. Berkshire Hathaway, Coca-Cola reporting earnings that were strong. You see a lot of consumer discretionary doing well. So the thing that's dragging us down are the chip stocks. And again, that is just a bleed through to what we saw in the Kospi trade when it fell more than 10%. So Micron, AMD, Nvidia, Broadcom, all doing poorly. Nvidia no longer the world's biggest stock. That crown goes back to Apple. With the different sectors that are declining, only a few of them are down this morning. Only 2, I believe, are down there. That is correct. Industrials and infotech, again, it's the chip stocks that are dragging us lower. Consumer staples, healthcare, materials. A safety feel to this market, a play for safety, also helping that. Again, we had good earnings from the likes of Coca-Cola. Coming up, we're going to talk more about earnings. Boeing surprises investors with a major cash flow beat, but book a big charge on Air Force One. We're going to speak with Meghan Welch of BGL. That's coming up next. This is Bloomberg Open Interest. Let's get you some top calls now. With that is Bloomberg's Nora Melinda on the analyst action. Hi, Nora.
Hey, Dani, I've got 2 downgrades and a price target cut for you this morning. First up, let's take a look at Bank of America downgrading Exxon to neutral from buy. The analysts over there saying they see potential downside if a deal is reached in the Middle East. Shares of Exxon still higher by about 0.4% this morning. Next up, looking at TD Cowen downgrading Intuit to hold, citing a challenging setup and a lack of confidence in growth. The stock's still in the green nonetheless, higher by about 3.4% right now. And finally, Tesla's price target cut by $20 at RBC Capital Markets. The analyst saying a potential merger between Tesla and SpaceX could be difficult to replicate. Its price target slashed from $500 to $480. Shares down about 1.7% this morning. Those are your top calls. Dani?
Nora, thank you very much. Let's get back to this morning's earnings. Boeing beating free cash flow estimates for the second quarter. That surprise, though, did include a new $280 million charge for the Air Force One program, which is years behind schedule and billions over budget. Shares, though, are up 2.25%. Joining us now is Meghan Welch, Managing Director at BGL, where she leads the firm's aerospace, defense, and government services practice. Meghan, so great to see you. Thanks for stopping by.
Absolutely. Thanks for having me.
Can I just get your first take on these results?
Even though the results were imperfect, I think they were very telling and sent a really positive message to the middle market. So the commercial aerospace market is transitioning from a story about recovery to a story of growth, albeit constrained growth. The free cash flow was a surprise to the market, and I think that really tells the market around Boeing is coming back on their production rates that they have, and a lot of the risk, though, is getting pushed down to their supply base. So there's a real demand signal from Boeing. They're being able to increase their production rates, and it's a very positive story overall, despite the charge off on the defense side.
See, that's really interesting because you note this in your reaction to these earnings, that the bottleneck doesn't rest with Boeing anywhere. So where is the bottleneck, and what would it take to change that?
That's a good question. So the commercial aerospace supply chain is very complicated. There's lots of players, but really anyone who has spec'd in positions or any kind of content in the forgings, castings, specialty materials and component sectors, they're really, really squeezed right now with record build rates at Boeing. And that's where we're seeing a lot of the bottlenecks. And it's created huge opportunities in the middle market M&A because it allows more consolidation, more opportunities to grow in projections. But that's where a lot of that bottleneck lies in commercial aero.
Does that M&A happen in the way of like a Boeing buying more things, like it did with Spirit AeroSystems, buying that back, or is it happening on a lower level?
So that was a much larger transaction. The Spirit AeroSystems was very defensive. That was Boeing's way to really get control over their quality and to regain the trust of all of the regulators and the FAA. And so to be able to do that, they had to bring it back in-house and be able to get more control on their production and become less of an integrator. What we're seeing now is the production and the supply chain that supports the commercial aerospace market is vast. It's a lot of smaller middle market shops that have working capital needs that really require them to kind of lean forward to be able to meet these build rates that Boeing has. So it's a little bit of a different scale. Spirit was totally defensive, but it was a great move for Boeing, even though it did hit Boeing's cash reserves and it did hit Boeing's kind of commercial recovery inflection point.
So then what does M&A look like from here on out for more of the middle market players?
I say this a lot, but I think M&A in the commercial aerospace market is starting to hit its stride. It's in the very early innings of a super cycle. We've been seeing a lot of M&A interest on the aftermarket, and that's kind of repair of older planes that are still flying. But on the new build cycle, now that Boeing has been able to regain the trust of the regulators, be able to self-certify in certain instances on the MAX, they're starting to ramp up their production and opening up the new facility up in Washington. It's really sending a signal to the market that game on, production is ready to go, and we're going to start to hit, those max production numbers that we wanted to hit back in 2019.
Two tailwinds, forgive the horrible pun for the plane industry, but two tailwinds that seem really positive for Boeing and really the entirety. And I know you had a lot of these discussions when you were out in Farnborough at the air show recently. You have a consumer that's still traveling and a lot of demand, especially for the more premium type demand in airlines. And then you have countries that want to spend more on their defenses. How has that been shifting the mix of demand in the overall industry?
Again, I think demand is kind of coming from both sides, right? So there's more about this constraint. Who is really playing for the constraint that they have on the supply side? So people that have access to commercial aero and defense are really sitting in a great spot on one hand, but also in a constrained spot on the other, because how do you shift your priorities? How do you determine where you're going to be able to supply to, whether it's defense or commercial aero? But it's Boeing is benefiting from the defense boom as well, as you saw. I mean, defense was up, I think, 13% in this earnings. I think it's going to continue to drive a lot of opportunities for Boeing in the long run.
Well, this is not an administration that's shy about trying to tell companies what they should be doing or take stakes in companies. Obviously, the FAA had been previously more involved with Boeing. In the past, they've ceded control back to them for certification. How does that evolve? How do you see this administration's involvement as they do push for more defense spending, as we run out of ammunition, as we continue the war in Iran?
It's a tough situation that we're in from a national security perspective. Defense spending is going to continue to grow, and we're going to continue to have those demand signals. But there needs to be a real signal shift at the White House. And we're starting to see that with Hegseth and some of the actions that Feinberg's doing in the Office of Strategic Capital. But showing those long-term demand signals is critical to the middle market and critical to the supply chain to be able to show longer-term demand and flexibility around contract structures. I think the Air Force One program and the charge-off for Boeing is a perfect example of how firm fixed price contracts with defense often become overbloated, overcost, overrun, and super delayed, and that results in these massive charge-offs.
Meghan, this has been so interesting. Thank you so much for joining. Really appreciate your time.
Absolutely.
Meghan Welch of BGL. Coming up, beverage stocks are moving higher this morning as Coca-Cola raises its full-year outlook on stronger World Cup sales. All the details for you right after this commercial break. This is Bloomberg Open Interest. A quick check on your equity market because we continue to decline, down now at 0.25% at the lows for the morning. The Nasdaq's down 1.6% on the verge of entering a correction. The Russell 2000 index also down 0.5%. At the same time, Brent crude, that falls, as do your 10-year yields, down about 3 basis points. Nvidia having a rough day, no longer the largest company in the world. That belongs to Apple now. Micron down 10% after the Kospi's 10% fall. Visa up 0.5%. They're letting go about 2,600 employees as they pivot to more high growth areas for the company. And then PepsiCo and Coca-Cola, both of them are higher after Coke's earnings up 6.4% with strong results, a slight lift to their forecast, thanks in part to what they saw from World Cup sales. Let's get more on those earnings. Bloomberg consumer reporter Red Brown joins us now. Red, was this just thanks to the World Cup that Coke beat?
No, I mean, I think obviously that's going to be a big impact, especially in their most important market, which is North America. It accounts for around 40% of the sales in the last quarter. Obviously, there's a lot of people in North America celebrating the World Cup. But if we look at the results, it's pretty broad-based. So they saw growth in all of their operating regions. So I think what their company will probably say is that this is more of a factor of sort of the long-term strategies that they've been putting in place, making sure that they have the right sort of product mix, making sure they have products in the right sizes. That's a very important part right now for people, especially as they feel the pinch on their wallets. That will still kind of attract people depending on the price.
Well, one of the interesting things I thought you and the team wrote about was this pivot to sugar-free soda. I myself have a Poppy every now and then, but it has gotten more competitive. I think what Pepsi bought Poppy, the sugar-free soda, is just how big of a growth area is that for them away from like the traditional sugary sodas that we're used to?
Yeah, definitely. That's a really important factor here as people become just more health conscious. We see this in other markets as well, from, across the consumer sort of spectrum between alcohol and beauty and skincare, all these things. People are very worried about their sort of, or not worried, but are very attentive to their appearance. And this is, yes, certainly going to be one of these drivers, these innovation pipelines that all of these companies need to sort of pay a lot of attention to. That is definitely where the consumer is heading. And I think we also see that with the smaller sizes as well, right? So, obviously you're getting less sugar, even if you are maybe in, cheating with a full-bodied Coke, if you will.
A full-bodied Coke. Well, I guess full-bodied Coke, though, also has real cane sugar in it now, right? That was something, what was that, early last year when the president wanted it, and Coke, in one of their earnings releases, said that they were offering that now?
Yeah, right. No, so I mean, look, it's incremental sort of gains, and like how can we make sure that we still have the same branding and product that people are familiar with, but maybe if it's marginally healthier, that might draw in people at the sort of margins.
I always think, okay, so they benefit obviously from World Cup, more sales because people are here in the U.S., but they sponsor so much, and presumably sponsoring the World Cup, especially the most expensive World Cup that there ever has been, is really expensive to them. I mean, how do marketing costs figure into all these?
I think it's, obviously, yes, you're right. It's a great point that it is expensive to do this, but if during the earnings call, they were really sort of spent a lot of time just in terms of the number of impressions and that they were able to generate from this. I think it was something like 9 billion views on their videos that they were able to create with 2,500 content creators. So it does seem like this does pay off, right? Like if you're able to get that kind of sort of attention, I think any brand would bend over backwards to make sure that they could get that many of eyeballs on their products. And some of the commentary during the call made it seem like that is going to have these sort of longer term effects, right? Like so people have kind of either reconnected or deepen their connection with the brand. There's other aspect of that they spoke quite a bit about is the amount of data they're able to generate from these impressions and these views and things like that as well, which does help them sort of spin this forward as well. So it's not just like it's helping you in this quarter. There's going to be some longer term benefits as well if you're able to kind of take that insights that you got, put them into product innovations, put them into future marketing campaigns, and continue to sort of, get dividends from this investment.
By the way, a lot of consumer stocks, especially the Pepsi rallying this morning too. Is there some look through from these results into other consumer companies and the ability of consumers to continue to buy and continue to spend money on these items?
We're early days in the earnings season. We'll get a little bit more of that view, especially with Procter & Gamble tomorrow. So another one of these sort of like name brand companies that are going to have a view into every segment of the population. So maybe a bit too soon to say how much we can read through with Coke, but I think as the results trickle in over the next week or so, we'll definitely get a better view.
Well, I hope you've blocked out time on your calendar for us, because I'm sure this is not the last conversation we'll be having in near term. Thanks so much, Bloomberg's Red Brown. Coming up in the next hour, we're going to speak with Meredith Whitney on just this, the health of the consumer, but also AI, plus banking M&A. Plus, we'll speak with Ben Zweig from Revelio on the AI labor market, and Liverpool Football Club CEO Billy Hogan will be joining me in the studio. This is Bloomberg Open Interest. 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger. Matt Miller still on paternity leave, and it's a market that has started to turn negative as the session has gone on. We are looking at something near a 2% decline for the Nasdaq as it itself enters a correction, with the S&P also moving lower this morning. It's that sell-off from the Kospi that is bleeding into today's session. We are just waiting for some data crossing the terminal at the moment. We're looking at it now. It is Conference Board Consumer Confidence. The July numbers coming out lower than expected. Let's get straight to Bloomberg's Michael McKee, our international and economics and policy correspondent, live from Washington, D.C. Mike, what you looking at?
Well, it's a little bit worse than even on first glance, because the prior month, June, was revised up to 92.2, and it comes out at 90.8 for July. So a drop in confidence, which wasn't totally expected because there was a feeling the earlier drop in gasoline prices this month might push confidence a little bit higher. Still waiting on the breakdown of other numbers from the consumer confidence. Now we've got the present situation that falls to 114.9 from 116.4, and the expectations index rises a little bit, 74.7 from 74.4. Not really going to be a whole lot of difference in that, but it does appear at this point that people were a little bit less confident about where things are going in the economy during the month of July, even though gasoline prices fell for the most part during the month. Now, the one thing that this survey is really based on is employment. And right now, the number of people who think that jobs are plentiful fell to 24.5 from 25.5, and hard to get falls a little bit to 21.5 from 21.7. It's basically an improvement in no change in jobs. So the confidence basically probably comes from the oil price situation rather than the labor situation.
All right, Mike, thank you very much for breaking that down. Bloomberg's Michael McKee in Washington, gearing up for a Fed rate decision tomorrow. Joining us now is Meredith Whitney, CEO of Meredith Whitney Advisory Group. Sentiment is one thing, how consumers actually act is another thing. Just some of the earnings this morning, UPS solid, maybe some issues around the margin. Coca-Cola, people are still buying drinks. What is your read as we start this earnings season on the consumer?
Well, I think the Fed only needs to look at its own data, which is, I look at weekly credit card balances, and weekly credit card balances show the consumer absorbing higher gas prices and actually inflation peaking in mid-April, even though gas prices peaked in mid-May. So you've seen prices decelerate from May's time, and even though there's been basically almost $1 increase in gas prices over the last month, credit card balances, which are not people revolving balances. These are just balances based on spending, and those are continue to decelerate. So they're up, but they're not up as much. So I think the Fed, and this is Fed, not New York Fed, Fed data, is going to give them a lot of reason to stay on hold. I think this week.
Stay on hold or allow them wiggle room to maybe even hike?
I think they stay on hold, and they'll probably still have this tough guy language with this hawkish language that gives them wiggle room. So I think that putting these people on these special task force buys Chairman Warsh time, right? I think that was one of the issues, right? He's going to look at every aspect, but it will take these guys 6 months, several months to actually put a working group together, do their analysis and find a conclusion. So he's got time.
There has been this argument, though, that what a better way to show that, one, the Fed is still independent, and two, to show that you're not giving forward guidance by just going out and hiking and almost surprising the market. Do you put much credence to that does achieve some of his goals?
I think that's overthinking it a little. I think his bias is to wait and be really right. So he's a very thoughtful, confident guy, and I think he will wait until the time's right to raise rates.
Is this a Fed, though, that needs to figure out some way to get long-term yields done? It's a 30-year It's been a 30-year yield that's been above 5% for the longest stretch since the early 2000s, I think around 2007 or 8. He himself has called out the issues with this housing market and mortgages more dependent on that. It's something that perhaps at some point already is starting to weigh on risk assets. Is this a Fed that really needs to do something about long-term rates?
I don't know that they can do something about long-term rates. I mean, it's a fiscal fiscal issue, which is nobody in D.C. has any appetite to rein in debt. And that's going to be a persistent problem with higher rates. And, I don't know that so many countries are in the same boat that we are, but until we focus on that, which there's been absolutely no discipline or willingness to focus on that, rates are going to push higher.
But again, isn't this a Fed that will need to really hike rates in order to show that commitment to bring it down? Because, for example, things like government spending is continuing. And then there's some crowding out of the bond market of all of the issuance we're getting from these hyperscalers. I mean, those forces seem, again, those are ones outside the Fed control, but ones that have really been weighing on this Treasury market.
I don't know that what the hyperscalers have issued in terms of debt is crowding out anything as massive as the Treasury market. It's just complete, like it's peanuts compared to the size of the Treasury and the issuance, like the rollover of the Treasury market.
What do you make of general crowding in financial assets of both IPOs, equity issuance, and the bond market? This idea that for the first time we are seeing real supply coming online, that it had been at least for the equity market when where companies stayed private for longer, there were take privates, and you didn't really have robust issuance. And now that's starting to change with all these IPOs. We're getting above $1 billion. Does that change something for markets?
Well, I think you've seen people sell other stocks to buy, new issues. So yeah, there's I don't know that there's a crowding out. There's so much money, swashing around this market that it can absorb a lot. But yeah, people are selling certain stocks to buy others, and that's just theory of displacement. It's not money's coming out of the market; it's just choosing different assets.
People do love to point to this idea, though, that when you get this many IPOs, it's something of a peak in the market. I mean, could history rhyme this time?
I think historically, people like to do deals at high valuations. Banks are, in banking anyway, banks aren't bought, they're sold. So people love to sell at high valuations. And I'm sure, a lot of these companies need to go public because they need liquidity for not only their private equity investors, but their employees as well. So there are other issues at hand. But I think the market's been able to absorb a lot.
It's true. The market has, and companies too have. I mean, this earnings season, expectations are so incredibly high, even though we still have elevated gas prices. We have new tariffs coming on. Earnings expectations for growth year over year are in the high 20s, something we usually don't see out of a recession. What do you make of just the high bar of expectations we have for corporate America this quarter?
I think it's a economy, it's your tale of two economies, right? So you have an economy that is with the semis and with the high-end consumer, the high-income consumer doing incredibly well. And look, banks have, or financials, or the market in general has bought back a lot of shares. So there's a lot less available shares to buy. And then, the economy's been robust. So the banks set the tone in terms of had incredible earnings, incredible trading, incredible capital markets. The power of the World Cup was an exponent of the Taylor Swift effect, and that's tremendous. And people have been spending. What is amazing in terms of when I look at consumer spending, you look at grocery spend, which has been negative, and then it was barely positive. So you see certain people cutting back on spending, but travel and leisure have accelerated while gas prices have gone up. So I think that's World Cup. So I think that the comps in the forward months may be difficult. But for now, things are good.
I was going to say, isn't that something that can't really be recreated? We saw so many international people also come in to the U.S. If they were able to make it through the border, come in. You had Europeans come in, even though the narrative had been that the U.S. economy was so much more strong than Europe. People were willing to spend money not only on those expensive flights, but for the most expensive tickets ever for a World Cup. I mean, it's hard to see how this economy would really create that versus a one-time boost.
The other thing that happens is, any money that had been earmarked has been pushed out the door. So there's been incredible sort of fiscal spending, just remnant fiscal spending that's been pushed out the door. So I think we're getting into the third quarter, which will still be strong. The fourth quarter, I think, will be a little bit of a reckoning. Late part of the third quarter, fourth quarter will be a little bit of a reckoning.
All right, Meredith, you're going to stick around with us. Much more to discuss, including some of the banks. That's Meredith Whitney. Let's get a check on your markets, though. About 40 minutes into your trading day, and it's still tough out there, down 1.8% for the NASDAQ 100 following that 10% decline for the Kospi in Korea's session, the second worst since 2001. So we are poised to enter a correction with a 10% drop from the record. Apple, though, that's one of the bright spots. That's beyond a $5 trillion market cap. Yields coming in 3 basis points ahead of tomorrow's decision as oil moves in. It's now just above $87 a barrel. Let's look at some of the individual movers. With that is Nora Melinda. Hey, Nora.
Hey, Dani, 3 stocks on the move today, and we will start with tech. Applied Digital down less than 0.1% lower. This is after the company posted results that blew past Wall Street's estimates, so the bar is still high. Fourth quarter revenue climbing 407% from a year ago, but the stock taking a breather, so we are seeing shares of that company lower. Sticking with tech, let's move over to Apple. Apple partnering with Klarna. This is on a new product leasing program called Apple Upgrade. The program offers pricing options for the iPhone, Mac, Apple Watch, and iPad online and in retail locations in the United States. If you take a look at shares of Apple, they're down by about 0.2%. Klarna, though, pushing higher, up about 0.1%. And we do know, of course, we got that headline a bit earlier about Apple surpassing that $5 trillion mark for the very first time. And last up, some job cuts at Visa, giving the stock a pop higher by about 0.8%. The company announcing that it's eliminating 2,600 or 7% of its workforce. It's part of the CEO's efforts to make Visa more efficient amid a tough payments industry. Those are your morning movers. Dani?
Nora, thank you very much. Coming up on the show, BlackRock wraps up a $12.5 billion bond sale tied to a Meta data center project. We're going to get the details. That's coming up next right here on Open Interest. Meta and BlackRock are teaming up to build a data center complex in Texas. Meta says total development costs for the project, including buildings, power, cooling, and connectivity, will come to about $14 billion. Some of BlackRock's investments will be funded by a $12.5 billion in debt financing. Joining us now is Robert Schiffman, Bloomberg Intelligence Senior Credit Analyst. And again, Robert, it just feels like the need for debt to fund data centers is coming from every corner of this universe.
Yeah, there's going to be a lot more spending and a lot more borrowing. And that's adding a little bit to the panic of this market. But I'll tell you, people should be calm. Fundamentals look fantastic, but technicals are off. You know, from an equity valuation perspective, you just talked about a NASDAQ correction. But think about where the NASDAQ is this year. We're still up 7%. We're up 20% over the past year. So we're off the highs. And when you think about spreads, you know, we are definitely wider, particularly out the curve. We're seeing steeper curves as more and more bonds come, but there is still a tremendous amount of demand. And for private deals like this, we're actually tighter. We're 20 basis points tighter. If you price it right with the right structure, bondholders will be there, and they will be there in size.
Is that just an illiquidity premium that's getting priced in there with the tighter spreads for private deals?
You know, it's not so much that it's that illiquid. It actually, even though it's a private deal, it's reasonably liquid. It's more of they priced it right. So this deal is priced well wide to where hyperscalers' unsecured debt is. So it's, you know, if you can buy this bond 100 basis points or wider than where Meta trades, why wouldn't you do it?
All right, Robert, thank you so much for joining us on the latest. That's Robert Schiffman of Bloomberg Intelligence, and Meredith Whitney is still with us. Meredith, again, so much spending going into this AI project, and maybe this brings us around to banks because they have been so fully involved in it. For financial companies, financial services, and banks otherwise, should there be an AI boom that we are riding off, does this make them all the more attractive?
The banks, like a lot of these semis, are at historic highs. So they have, you look at Goldman, Morgan Stanley, JP Morgan, PNC, they're all trading at all-time highs. And what they've been doing, instead of doing deals, they've been buying back shares. And buying back shares at really expensive valuations, which is far from accretive. So what I'm waiting for is one of these major banks to actually do a transformational deal. Historically, when financials have been trading at high valuations, you've had transformational deals. I mean, you think about the 90s, you think about the early 2000s, that's what's been happening. But so many of these banks have bad PTSD from deals done around the financial crisis. I think that the first one out of the box will do the best deal, and I think that will benefit the most.
Who do you think the first out of the box might be, and what type of transformational deal?
Who would you guess?
JP Morgan.
Yes.
I also say that because in the earnings, we did hear from Jamie Dimon, not this quarter, but the one before, saying we're on the hunt, whereas Morgan Stanley has always sounded more reserved with Ted Pick.
Well, Morgan Stanley did an incredible deal in E-Trade, and Morgan Stanley did an unbelievable deal with Smith Barney during the crisis. So Morgan Stanley's done incredibly well. Morgan Stanley's trading above 4 times book, so Morgan Stanley's in a good spot. But I think when people thought that Jamie Dimon would retire after the new headquarters was built, that time has come and passed. I think he actually is on the hunt to do something big, and he has actually the confidence to do something transformational. And as huge as this deal sounds, I think the deal that makes the most sense for them is something not so out of the box, but Revolut, which is a UK fintech that's started 2015 that has over 70 million customers. JP Morgan, Jamie's also talked about an ability to grow in Europe for the first time, not building branches, but building a digital network. And it can do it. So JP Morgan currently has about 2 million customers in the UK. It's broadening out in Germany, but it can get somewhere so much faster if it does this type of acquisition. So the last valuation of Revolut was $115 billion, which seems like a lot, but their compounded growth rate is their four-year compounded growth rate is 76%. So they're growing like a weed. They have these things called, they have 75 million Henrys, high income, high earning, not rich yet customers, which JP Morgan doesn't have. It's a digital solution that JP Morgan doesn't have. It's the same price tag as a lot of these European banks without the legacy technology that nobody wants and the assets that JP Morgan definitely doesn't want. So I think this could be a really compelling deal. And I think not only JP Morgan has the shareholder confidence, the board confidence, and he's got the ultimate man's confidence to be able to lead the banks to start doing M&A, which they should be doing anyway.
Does that, and I don't want to get too sidetracked on this, but if he were to do something like that, does that mean Jamie Dimon stays on for longer because he won't see the transformation through, or does he hand the next successor, like, here's a nice little pretty package for you to work on?
Oh, I think he will be excited to work through the deal. And so I think he has, he's going to say, it's always at the board's discretion, but I would say he has at least 2-3 more years, and he can tie this acquisition up as a success and a nice package and pass the baton.
How much of it, though, would be about European expansion versus digital banking in the U.S.? Because digital banking in the U.S. is incredibly, I guess globally it is, but in the U.S. it's incredibly competitive right now.
It's incredibly competitive, and so you are actually, Revolut is in the process of trying to go through the application to get into the U.S. I think that a combination of Revolut and what Revolut has today and what JP Morgan has turbocharges the combination, and 1 and 2 makes 5 instead of 2. And I think Revolut has a lot what JP Morgan is aspiring and is working towards, and JP Morgan has so much of what Revolut would want.
It's interesting because a lot of the banking deals that we've seen in the past year, I can only actually think of like one really big one, and it was a cross-border one with Santander coming in and buying Webster.
Yeah.
And I wonder if that model looks more attractive to have cross-border deals than a regional bank, for example, buying a smaller regional bank, or if there might be still more M&A dry powder to happen there.
Well, I think the less exciting deals that you could see would be like a Goldman buying a State Street or a Northern Trust.
That would be huge, though, if they did that.
It would be huge, but what does it do to the multiple of Goldman Sachs? Would it take that risk? I think that I fear that they still have PTSD from Green Sky, and they're going to take it really slow. So those are the obvious deals. The U.S. on U.S. deals are the obvious deals, and they're big. But what does it do? Is it truly transformational, or is it just more of the same and broadening the mix? I'm not saying that it wouldn't be necessarily accretive, but it's a little ho-hum. I think a truly transformational deal would be cross-border and also complementary in terms of advancing the tech stack further and doing so much more with what you have and what you like. JP Morgan doesn't have these a lot of the younger customers that it aspires to have, and the younger customers don't have access to a lot of what JP Morgan has.
Yeah, and it's super interesting, Meredith. Thank you so much for joining us.
Thanks for having me.
When and if this deal happens, you're obviously coming back and taking a victory lap. Meredith Whitney of Meredith Whitney Advisory Group. Still ahead, we're going to be speaking with the Revelio Lab CEO on how AI is affecting the job market. They are out with a fresh report. That's coming up. This is Bloomberg Open Interest. Welcome back to Open Interest. Let's get a check on your equity market this morning, nearly an hour into your trading day. And it's a NASDAQ that is poised to fall 10% from its high into a correction, down 1.8%. The S&P down 0.2. It's the follow-through to the Korean session, to the concern about chips, to the concern about deals, and the concern of advancements made in the Chinese AI ecosystem. Will some of the earnings we get this week help relieve any of those concerns? In the meantime, 10-year yields, at least this helps. Kind of, not even the small caps, but still that's down 30 basis points for your 10-year yield. Brent crude down nearly 2%. Nvidia still having a big day, and now it has fallen below the market cap of Apple, which passes $5 trillion for the first time. Pepsi, those shares are higher alongside Coca-Cola after Coke reported positive earnings. PayPal doing well because Visa announcing that they are eliminating 2,600 jobs. I should say PayPal also had earnings that beat, but Visa trying to refocus on higher growth areas, including AI, which is the perfect setup for a conversation we're going to have after the break. Revelio Lab CEO on why companies are adopting AI and adding workers. That's coming up next. This is Bloomberg. AI is changing the labor market, but not necessarily shrinking it. Revelio Lab's latest AI labor market tracker shows companies adopting AI have grown headcount 27% more than non-adopters since late 2022. However, most of that growth is going to senior workers, whose headcount is up 31%, compared with just 6% for junior employees. Let's get more on the state of the labor market. Joining us now is Ben Zweig, co-founder and CEO of Revelio Labs, a workforce intelligence company which analyzes data from LinkedIn, Glassdoor, H-1B visa filings, and other public sources. Ben, this report, I know just out this morning, is so interesting. I want to talk about the difference between entry level and more senior level, but first, just on this idea, the more companies are adopting AI, the more they're hiring. How then do you square that with individual announcements? We just had Visa this morning saying we're reworking things, we're investing more in AI, and we're letting go 2,600 people. Are those two things just unrelated then?
I think they're unrelated. Yeah, I mean, we have not seen layoffs of the most exposed firms. It's actually declined quite a bit. We've seen growth and layoffs really in the types of industries that are not exposed to AI at all, like manufacturing. So that's really driving the layoff results. Sometimes when companies attribute layoffs to AI, that's really just like a narrative trick, I think, and doesn't square with the evidence that the companies that are adopting AI the fastest are the ones that are growing the most.
And they're growing, again, with their senior level employees. Maybe entry level jobs aren't as robust. Does that mean the worst of the fears that entry level jobs will cease to be plentiful and the career sort of pipeline will be less robust, that those are starting to play out?
I think so. So it's a weird time for younger workers. I mean, one thing I'll say is that, during times of uncertainty, younger workers suffer from those because they're a more speculative bet. Whereas if you want productivity today, tomorrow, you hire more experienced, safer bet workers. So that's hurting younger workers. Another thing is that which makes me a little more optimistic is that, it used to be when we talked about AI, we were talking about chatbots. And everyone and their grandma can use a chatbot. It's like super low barriers to entry. And what happened was that, these chat tools were being used to execute on tasks, but not really used to coordinate tasks and orchestrate tasks. And this coordination and orchestration effort was really biased towards senior workers. They have more experience managing. So it was kind of like a seniority biased technological change. But now when we talk about AI, we're talking about agentic stuff. And that's complicated. Like, this is pretty complicated to use, and I think it favors those who are digitally native. So I think that's helping younger workers. But just to go more pessimistic again,
balance us out, Ben.
Yeah, we gotta tell the dark side, is that the process of finding jobs and matching with employers is really broken.
Yes. Okay. Wait. Can you talk more about that? Because presumably, if I'm a younger employee, I can just use AI and spam the world with my application.
Yeah, exactly. There's all these platforms spinning up where you could just like auto apply to 1,000 jobs a minute, which sounds great, but it's becoming like this high frequency trading type of model. And the employers are getting they're getting completely signal jammed. So they're overrun with just like all these, applications that seem great on their face, but the utility of posting a job is really eroding. So what's happening is that companies are just not posting jobs, and they are relying on networks. And younger workers don't have networks.
Yes.
So that is, they don't have this like investment into their reputation that older workers have. So it's really hurting younger workers. So I think they're very frustrated. They're having a hard time finding jobs. It's a very tough time for them.
But at the same time, on the other side of that you have, I know you talked about in your report that candidates complaining about recruiters ghosting are up 9%. So it feels like the other part of the contract, something's going wrong too.
Yeah, I think so too. I mean, on the one hand, employers are starting to try to use AI to kind of like sift through all this, but you can't really blame them that much, because what are you going to do with thousands and thousands of applicants? So they're starting to kind of have a preference toward the ones who applied sooner. So that's where it gets like a little bit more high frequency-esque.
Can we talk about wages too? Because there does seem to be, anytime I either go to San Francisco or talk to anyone who lives in the Bay Area, they seem to have a much more, you kind of get a variety, but maybe more pessimistic of how wealth is going to be transformed, that we're going to have a permanent underclass. And if you haven't earned generational wealth now, you're out of luck unless you already got that Anthropic job that's paying you a lot. How are wages evolving, especially ones tied to AI work?
Okay, so it used to be that the most exposed jobs, the jobs that touched AI the most, were had a premium. They were specifically more higher paying. Now that's eroded basically to zero. So now we're seeing more equivalence between the pay of jobs that are exposed to AI and the pay of jobs that are not exposed to AI. So it's no longer the case that AI exposed roles kind of like, are the higher paying roles. So that I think seems like good news on, in terms of equality and all that. But I think it's still wrong to say that we are just like driving labor share of the economy down to zero and it's all going to be driven by capital. That is not borne out in the evidence. And I'll say, just a caveat about this tracker,
Sure.
We are tracking what is happening to the labor market today based on what has happened so far. That's not to say that, things can't get weird in the future, but I'll leave that to others.
Get weird feels like a nice way of saying that things might be like fundamentally different. But I have to say, in your report, you do talk about this idea that the work itself is shifting so rapidly, that the job titles are staying the same, but what people are doing are really different. To me, that also speaks to a difficulty in the pipeline. How do you train people up for a job that is changing literally month by month?
Yeah, it's really dramatic. And just for context, in normal times, the actual work content of the economy, like the stuff that gets done in the economy, turns over about 4% a year. So if you look year on year, like the collection of tasks in the economy, it turns over a little bit as like work changes and evolves. But in the last year, that kind of shot up to 8.5%, which is bigger than it's ever been. So there's a huge transformation of the work tasks, and the vast majority of that, 93% of that, is happening within occupations rather than between occupations. So it's kind of, below the surface. And it is very tough because, I run a pretty small company, and, people wear a lot of hats. Turns out that phenomenon is happening in every company, where you have someone in marketing doing HR work or product design. The OpenAI economics team just came out with an article that is sort of corroborating this that came out yesterday. So that's sort of hot off the press too, that people are kind of, expanding beyond the scope of their job title. So I think we're seeing kind of like the job title meaning less, and which I think on net is good news, because it means that, the economy can adapt without needing to fire workers and hire new ones. This doesn't have to. So, I mean, to put another way, we can see the automation of work without seeing the automation of jobs.
That's really interesting, Ben. Thank you so much for joining us again. Highly recommend everyone gives this a read. I mean, it kind of assuaged some of my concerns and brought up new ones, so that's always fun.
No, that's good news. Got to stay balanced.
It made me think, which is always good. Ben Zweig over Revelio Labs, thank you so much for joining. All right, let's get a quick check on your markets because we are over an hour into your trading day. And maybe not AI fears for jobs, but AI fears for this market are permeating in just the advancement of China. What it means to continue to have deals and spending. We're going to hear more about CapEx as we get earnings throughout the week. The Philadelphia Semiconductor Index down 5.6%. The NASDAQ leading losses down 1.6%. The S&P just barely hanging in there as Brent crude also falls about 2 1/3%. Let's get a look at some of the other single name movers on our radar this morning. With that is Nora. Hey, Nora.
Hey, Dani, a few stocks on the move this morning. First up, let's start with UPS tumbling down about 4.7%. That's heading for its worst day since May. Investor concerned about the second half of the year, overshadowing that boost that we saw to its sales guide. The company's warning of lower delivery volume after a pullback in its key relationship with Amazon. Don't miss our interview with the CEO of UPS at 3:30 p.m. New York time. And also looking at Boeing, nicely in the green, up about 4.8% after generating cash flow that topped estimates for demand with this aircraft, with demand for its aircraft strong. Though Boeing also incurred a fresh $280 million charge for the Air Force One program, so also keeping that in focus here. Finally, JetBlue wavering, currently right now in the green, higher by about 1.3%. This comes after the company reaffirmed its outlook and it set a new long-term goal for 2028. The airline says strong demand helped offset high fuel prices due to the war in the Middle East. Those are some of your morning movers. Dani?
Nora, thank you very much. Coming up, Liverpool FC expanding its footprint across to the U.S. CEO Billy Hogan joins us next. This is Bloomberg Open Interest. Liverpool FC is looking to grow its global footprint with its sights set on the U.S. The club is launching its latest away kit today in Brooklyn at an event attended by both super fans like John Oliver and players. Joining me now, so pleased to say, is Billy Hogan. He is the CEO of Liverpool Football Club and Fenway Sports Group International. Billy, thank you so much for stopping by.
Hey, thanks for having me.
And look, this is a really cool event, and you've also noted that the U.S. is becoming one of your largest international markets. It's a tough market for sports just because it is so dense in its variety of sports fandom. What has changed to make Liverpool FC so popular here in the U.S.?
Well, I think, thankfully, we have been popular here in the U.S. We've got about 26 million fans that follow the club here in the U.S., and actually about 40% of our corporate partners are actually U.S.-based companies. So I think as a football club, we have a big following here. We have been coming to the U.S. Pretty regularly over the course of the last 20 years. We typically alternate between North America and Asia. So we're back this summer. We played in Nashville the other night against Sunderland. We play against Wrexham at Yankee Stadium tomorrow night, and then we play against Leeds in Chicago on Sunday night. And it's a great opportunity, number one, for the team to train. Obviously, that's an important part of this experience, but also for us to bring the club closer to our fans. Those 26 million fans, not all of them are going to get to Anfield, so it's our opportunity to bring the club to them.
Although I know Anfield is an incredible experience, so I'm sure a lot of them are looking to get there too. How much has the World Cup made a difference for you? Because obviously, so many more Americans were exposed to the sport of football, but when you think about the stars who really caught fire, be it Harling or Bellingham, I mean, they're not Liverpool players. So how has it translated directly into just your fandom?
I think generally any growth for football or soccer is a good thing.
We're allowed to say football on Bloomberg TV, by the way, just to let you know.
Good. We'll stay with football. No, I think generally speaking, it was great for football. I think that overall the experiences that people had, particularly traveling to the U.S. and traveling around to the different cities. Fenway Sports Group, which owns Liverpool, is based in Boston, and famously we had the Scots invade Boston and drink it dry. So I think it's just generally speaking, there's a tremendous amount of joy around the culture of football, and that can only be a good thing. And so I think that kind of wave from the World Cup will obviously help football more generally. And we're privileged as Liverpool Football Club to play in the biggest league in the world, in the Premier League. And so I think the most popular sport and the biggest league and one of the biggest clubs in the world, that hopefully is helpful for us as we continue to expand here in the U.S. And we do that through, as I said before, our corporate partners, but also through our digital platforms. The U.S. is our largest international e-commerce region, and so that's something that we're continuing to look at in terms of expansion of the overall club from a commercial standpoint.
By the way, that was probably one of the most incredible things to see in the World Cup, just international fans coming to the U.S. and the U.S. just embracing them with full arms. But part of the criticism that the World Cup did get was just increased commercialization. More games, and FIFA talked about expanding it for the next World Cup, and Bloomberg reporting out this morning suggesting that FIFA for the first time is looking for outside investment too. Do you think that those fears are real, that it sort of ruins some of the magic of the World Cup and the aims that FIFA supposedly is trying to achieve?
Yeah, look, that's a fair question. I think the biggest issue from our standpoint is looking at going back to that sort of the experience and the joy and the cultural experience around those matches. And I was privileged to go to the final. Obviously, a tremendous amount of Argentinian fans, a number of Spanish fans, but fans from other countries that were there that were just there to experience it. I do think that there is an element, particularly around the number of games that our athletes, our football players play. The calendar has been something that we're always concerned about, and so that's something that would have to be looked at. And from our perspective at the club, we've always looked at running the club sustainably, which does mean investment. It does mean commercial growth, but also looking at how we maintain that connection with our supporters and how we maintain that connection with the overall ethos of what Liverpool Football Club stands for.
Well, just on that note, there have been reports that Liverpool is looking at bringing in minority investors. Is that the case at this moment?
I can only refer back to the statement from FSG last week that we have been approached by a consortium that's led, managed, and represented by Amit Bhatia for a strategic minority investment in the club, and I wouldn't say anything other than that at this point.
What about, so you mentioned, though, that there are investments to be made. What specific areas would you be looking in with maybe outside capital or otherwise that you think that there might be gaps that could use an influx of cash?
Well, again, I wouldn't refer to anything other than what FSG said. I mean, from our standpoint, as the CEO of the club, my focus, along with our team, is on how we can generate revenue through the mechanisms that we are currently expanding. Mentioned retail partnerships, and how do we make sure that we continue to compete in the biggest league in the world.
How do you think about investment in the talent itself? I know last summer it was a record amount spent, bringing in 3 really star-rising players. This summer, you haven't really had any announcements. You also have Mo Salah on his way out, too. Yeah. Do you feel that pressure to kind of make another marquee signing?
I think the pressure, we always feel pressure. That's that's part of being in football.
True.
But I think really from our standpoint, if you look at from a stewardship of Fenway Sports Group over the course of the last 16 years, since John Henry, Tom Warner, Mike Gordon came in and purchased the club, the focus has always been on how do we improve the club to try and win trophies. Some summers there's been significant spends, other summers there hasn't, and that's correlated to the market, that's correlated to what the team needs, and that's correlated to always doing what we think is in the best interest of Liverpool Football Club, and that's not going to change.
And forgive me for this question because it's part of my tourist knowledge of the world of football, but it's always so interesting to me, the different models where you have maybe a lower down club that kind of bets on unproven talent, and then a big club like a Liverpool will come in and sort of buy that marquee talent when they've already been brought in. Will that ever change? Do you think that in a world where, you did just last summer spend £466 million, that you might change the model and spend maybe more and take a bigger risk on rising talent?
Well, there are financial regulations and financial fair play
which have changed. Yeah.
And we're actually entering a new phase of the squad cost ratio in the Premier League. So it'll be interesting to see over time how that impacts.
Do you think those are positive changes?
Yeah, we've always been in favor of financial regulations. I think that's something that, just from the standpoint of the overall competitive nature of football, I think that's important. And from a football club perspective, and this is frankly across Fenway Sports Group, we've always been focused on running the club sustainably. So my responsibility on the business side, as I mentioned before, is to generate as much revenue as we can to reinvest back into the club. And whether that's on the pitch, into the team itself, or whether that's infrastructure with the expansion that we've made at Anfield, a new training ground, new superstore, et cetera. We've always focused on how do we run the club sustainably. So everything we generate goes back into the team, and those decisions ultimately being made on the football side in terms of how that's invested. But again, all reporting back up to Mike Gordon principally, but John Henry, Tom Warner, our ownership at FSG.
And obviously results on the pitch are also incredibly important too.
Yeah.
When you finish fifth, it's also a great thing because you can go to the champions in the European competition. Financially, it's still good, but it wasn't good enough to keep Arne Slot around. I have to ask for the football fans out there, with a new manager coming in, Arne Slot comes in, wins the title year 1, year 2, finishes 5th. Well, what is the bar for the new manager for success?
Well, look, from Andoni's perspective, having spent time with him, obviously, over the course of the first couple of weeks of his tenure here, he's incredibly excited to be here. He's obviously focused on, as we all are, on winning. But this is a transition, and he's going to need time for his work to be done on the pitch. That's what they're doing currently in terms of preseason and the importance of the training aspect of preseason. But we're incredibly excited about his history and the way that his teams have played, and I think that sort of front foot attacking football is going to be something that our fan base and supporters are really excited about. And look, Arne was, as you said, he's going to go down in the history of Liverpool Football Club as having won the 20th Premier League title, and nobody could take that away from him. He's a tremendous individual and a tremendous human being, and we wish him well.
So Ariello gets a little bit of time to make some magic happen.
Everything takes time in football. Sometimes there's not as much as you'd
like years,
but
or
no,
1 year?
Let's let him get out there and do what he does.
I'm, again, really excited to watch the friendly tomorrow with Wrexham. Look, you already lead the Premier League in terms of revenue, and you mentioned some of the growth opportunities, be it around commercial partners or otherwise. But as you look at sort of the long term, the next 5-10 years, what do you think is really the growth pillar for Liverpool FC?
I think one of the areas that we're really focused on is our digital platforms. I mentioned earlier about the e-com and the strength of the United States as a market, but also our ability to expand that. And so that's something that we're working really closely with a number of our partners from a technology standpoint. UPS is a big partner of ours, so working with them as well to really look at how can we continue to grow that aspect. And that's not just about retail, it's about content, it's about our digital engagement. We've got over 225 million followers across our social media platforms, which is 10 times the number that follow the Yankees, to put it into some perspective. So, a massive digital platform that we have. And so looking at how do we utilize that to benefit the supporter ultimately? How do we bring more content to them? How do we engage with them on a more direct basis? And so that's something that when you look at kind of 5 to 10 years out, that's something we're really focused on.
How do you balance? So, I mean, we started this with saying just, Anfield has this incredible atmosphere.
Yep.
It's known for, maybe it's more working class roots. How do you sort of balance, having a more premium offering, having really interesting sort of suites and seats and that sort of experience, and the higher costs that come with it, but still keeping to those roots that you have?
Yeah, I think that's first of all, it's a great question. It's something that we look at all the time. We've gone through 2 different phases of redevelopment and expansion at Anfield, going from when we first bought the club, we were just under 45,000. We've gone through 2 expansions to get us over 61,000, now one of the biggest stadiums in the UK. With that comes the sort of business plan and return on investment, and some of that has to be invested into hospitality in order to, again, allow us to reinvest back into the team and into the infrastructure. So we look very closely at, what's the hospitality mix, and also from a GA perspective, how we make sure that we still have affordable pricing, and that's something that, the club, we've just gone through a inflationary increase coming into this year, but prior to that, we had frozen prices for 8 out of the prior 10 years. So that's something that we look at very seriously and we consider very seriously, and it is something that we're looking every day at match day revenues and how we balance that.
So do you also have to very much so incorporate kind of live feedback from the fandom, which I mean, football fans aren't exactly known for being calm and approaching things in an easy manner.
We get a lot of feedback. We get a lot of feedback, good and bad. But no, look, I think that's something that we've got to, from ownership on down, that's something that, we have always taken very seriously at Fenway Sports Group. We are stewards of Liverpool Football Club, and that's something that we think, this is a local football club that is rooted in Liverpool, and that's something that's really important. And in fact, when we go out on tour, tomorrow night at Yankee Stadium, when we're playing Wrexham, you'll see banners that are exactly like what you'd see on the Kop back at Anfield, and that's the connection that our supporters have, whether they're based in Liverpool or whether they're on the other side of the world. So I think that's something that we take very seriously. The community aspect of Liverpool Football Club is immensely important.
Billy, before I let you go, I also want to talk about the community work that you're doing here too, because it goes beyond Liverpool itself in the UK, but you are also investing in this community. Can you just sort of describe some of the work you're doing there, charitable and otherwise?
Yeah, so the Liverpool Foundation, the LFC Foundation, as I would say, they're the hardest working people on tour. We have a number of representatives from the foundation that literally from dawn until dusk, sometimes beyond, are running soccer schools and working with charitable organizations. We did so in Nashville. We're doing so this week in New York, and then we'll do it in Chicago as well. We're working also with the Make-A-Wish Foundation, so there'll be some folks from the Make-A-Wish coming to the hotel tonight to meet some of the team. We think it's really important not just to come in and play a match and then leave. It's really important for the foundation to be here, for us to create a connection to the community and to give back. And there's opportunities for us to do that with different charitable organizations here in New York and across the different stops that we do. We always do that.
By the way, you're investing in local football schools here. Can the U.S. ever produce like the top talent? I mean, they produced good players in the past, obviously, but so far behind. We see that every single World Cup.
Look, I think the World Cup shows, I think, on a global basis where the sort of talent level is. But at the same time, I think you've seen improvements over time. As an American, although now a dual citizen, it is one where, I'm always cheering for them as well. And I'd like to see more talent so that they can compete and ultimately win a World Cup. That would be incredible. That
would be indeed incredible. Billy, thank you for being so generous with your time. Really enjoyed seeing you. Again, good luck for tomorrow's match. That's Billy Hogan, CEO of the Liverpool Football Club and Fenway Sports Group International. Coming up on tomorrow's show, Sitara Sundar of JP Morgan Private Bank, David Miracle of Goldman Sachs, and the CEO of Logitech, as we set you up for a big day of earnings and central bank decisions. This is Bloomberg Open Interest.